you doing today?
Oh, great. Sunny day.
Yeah, it looks like a sunny day in Toronto. Now, where in Toronto am I looking? Behind you?
You're
We're
looking
looking
actually
south?
at Bayview. So this is north-south, and that's Bayview Avenue. And just to the north of us is Eglinton. So we're about halfway up the city.
Excellent. And how's the parking there? Is it convenient or?
Yeah, we actually get to street park. So I know the neighbor whose house I park in front of, and I know the crossing guard who is actually his brother. It's like a lovely little, very residential community other than the one little building we're in.
Nice, nice. Kind of similar to where we are. We're not downtown, but just close enough to make the effort, but far enough to make excuses, right? So we can't get downtown.
So it's a relaxed place to work that way, and kind of easy for people to visit.
Right on. So I'm hoping we can spend a few minutes talking about Fund 4 and how things are going, and love to have an update on Area 1 in terms of your business. And maybe I can kind of push it over to you, and let's talk a little bit about the fund.
That sounds great. And I guess before we start, how's it going with North Road?
Yeah, it's going really well. We've had an exciting year of change and transition, and a whole bunch of paperwork, obviously, as we're moving from one organization to starting our own firm. But really happy that things have transitioned as well as they have, and looking forward to 2024 and years to come.
It's really wonderful to see. That's awesome.
Thank you.
So thanks for having me. Farming in Canada has been very good. Farmland in Canada has been very good. And farming is actually exceptional right now. So, and it's traditional to the times. Like the reason that farmland's attractive is because it's not correlated to the broader economy, and it does really well in inflationary periods. And the reason that is generally inflation follows rising prices, like interest rate changes follow rising prices, and rising prices include commodity prices. And so farmers have never been as profitable as they have in this last year. Like Canadian farmers generally had a really good crop, and that crop is selling at a lot of money. And the inputs were a little higher than normal, but margins are way higher than normal.
Mm-hmm.
And so it's really profitable on an operating basis. And kind of the forecast of future profits means that land continues to rise.
Yeah. So our entry into this space was pretty good for timing.
Yeah, your entry into the space was great for timing. And this is the first, so you're in Fund 4, and Fund 4 is the first fund where we had so much experience behind us that we really had the right team in place to make the investments. So all of them are working. Like we don't have problems at the moment, which, because we're in operational partnerships with farms, is a really wonderful place to be, but also a little unusual. Like we kind of expect that, somewhere around 1 in 10 will have some issues.
Okay. Joelle, can you give us just a background on like the draws to date and your expectations for the completion of the draw?
Yeah, absolutely. So Fund 4 is 75% drawn. So 75% of your money has been called. And so you're still sitting on 25% of your money, which we will call likely all of it over 2024. So it's a little unclear just because we're working on some bigger deals right now, how much will be in the spring and how much will be in the fall. And farms don't tend to sell in the summer. So between when people seed and when people harvest, they don't tend to trade. So it's not totally clear how much I'll call in the spring versus the fall, but probably all of it gets called next year.
Okay.
And maybe I can just take you through a bit of the results of the fund and kind of look at where we are and how things are doing and what you own.
Yeah, that would be great.
Okay.
Even a few minutes on like the structure of Area 1 and how you're different than other Canadian farmland investment professional
Yeah,
and/or
yeah, yeah.
firms? That would be a helpful thing to hear again for our clients.
I'll start there and then go into kind of how things are going. So we partner with farmers, and we partner across their operations. That means actually different things in different places and to different people. So a bunch of what we do is we call full farm partnerships, meaning we buy into their home farm, we add money, we buy additional land, and we build out a farm that can accommodate not just the current farmer, but also their children. And so generally they're buying neighboring land. And so we're tripling the size of their farm, but we own everything with them. The land, the machinery, the inputs, like everything is one operation. And those ones make up 40% of our current investment. And interestingly, they actually have led to 60% of our total return. So they tend to outperform, both because we, like when crop prices go up, we're making 100% of that growth in margin. They actually take a 15% incentive. So we're making 85% of that growth in margin, and that's shared between us based on ownership.
Yeah.
But we're getting the whole benefit of it. Well, then there are farmers where they own their home farm. They don't want to partner across their home farm. Their home farm's actually pretty big, so it would be complicated to share machinery between two enterprises. So they own all the machinery. They put in all the inputs. We just own land together. So we own kind of additional land together. And instead of renting that for a cash rent, instead of saying, every year it's going to be $150 an acre, we rent that on a crop share basis.
Okay.
But in that case, just like in the other case, they actually own the property with us. So we've both put money in. So in both those cases,
are you on the title? Like, are we on the title with that farmer?
Yes. So it actually sits in a trust company. So it's a bear trustee, and we own the entire bear trustee. And then the beneficiaries are the fund and the farmer. Okay. And that way we have total legal control, because also their ownership stake is our safeguard in case they steal or like have any other issues. But the reason that ownership is so important is the reason farmers work with us, and their goal over the time period with us, which might range from 10 to 25 years, depending on how long people actually want to be invested in the fund,
right,
is that they eventually buy us out. Like, their goal isn't that we're farming with them forever. It's that at year 10 and every 5th year after that, they incrementally are buying us out. And so they own more and more of it on their own. Mm-hmm. And that's a really important thing because it's the right thing to do. Like, the goal of this is to be a business for us that makes money for investors, but also to ultimately provide a pathway where the farmers that we're working with can end up with the life they want. Yeah. And even though they're happy to have an interim partner, ultimately, eventually, the life that they want is independent ownership.
For sure. Yeah, for sure. In how many cases would you own the primary residence as well in the farm? In
the full farm partnerships, we almost always do.
Okay.
In any of the crop share partnerships, so where they own still a home farm, we almost never do.
Okay.
And then there's a third kind where we actually buy land and we improve it. And we do some of that improvement work. So we take overgrown pasture and turn it into cropland, or we take dry land, cropland, and turn it into irrigated. Some of that we do in what we call wholly owned land improvement companies. Mm-hmm. Mostly those are in Ontario. And some of it we do in partnership with farmers in full farm partnerships, and most of that work is in Manitoba, though we do have one farm in northern Alberta where we do a bunch of that work.
Very good.
So I'll just share a presentation that should give a bit of background. And so you should see on your screen a comprehensive look at Canadian agriculture. Perfect. And then we have a disclaimer. And I'll just kind of point out where we are right now. So the fund, which is Fund 4, has 24 partnerships. And the green dots that you see on here are the locations of those partnerships. So one in Eastern Ontario, one in Northern Ontario in an area called New Liskeard, a handful in Manitoba, kind of focused on Western Manitoba, so west of Port La Prairie, north and west of Brandon, and then a bunch in Alberta, largely on what we'd call the Highway 2 corridor, so going from Calgary to Edmonton, and then a little bit in Northern Alberta, one near Grand Prairie and one in Peace Country, and a little bit as you go south.
Okay.
We own 79,000 acres of land about, and we own that mostly as cultivated dry land or land that's pasture, a lot of which we're actually going to improve to cultivated dry land. So of the nearly 79,000 acres, there's under 2,500 acres that's currently irrigated.
Okay.
And while we're irrigating what we can, so in areas where that's available and the situation kind of benefits from it, that might grow a bit, but it's not going to grow a lot. So we are mostly what you'd call dryland farming, which means the rainwater is the water source.
Yeah.
This is a bit what we were talking about before. And I guess one thing we didn't talk about in that explanation of how we're different is the farmers don't earn salaries. They earn 15% of the income and 10 or 15% of the appreciation across our ownership instead of salaries in those full farm partnerships, meaning they're totally aligned. Like first, all their money's in as a partner, and then they're not getting paid a wage, they're getting paid a portion of the profit.
Yeah.
And the reason that's so important to us is, like in other asset classes, we think that you make your money when you buy. We think that actually buying these assets well is a critical part to doing well long term. And we think because we have these partners, we're actually able to buy better land in better areas at lower prices than if we had to buy on market through auctions or sales or agents. And we wouldn't know the areas as well. So we wouldn't pick as good stuff. About 85% of what we buy remains off market in transactions between our partner and their friends.
So overall, you think that's a benefit to us as owners?
Yeah, I think it's a big benefit. Like we think that on average, we're probably buying about 10% below market potential price, which also makes sense because agents are going to take 3.5 to 5. There's some other transaction costs. It's a bit of a headache. You don't have as much certainty. Like there is something really nice about being able to sell to the person you want to sell to.
So when the fund wraps up, when we're then selling these farms back, hopefully to the farm family, do we then still have to bear that discount or?
No, we sell at market. And it's a really, I think, quite thoughtfully designed exit strategy that actually one of our partners came up with. So the farmer identifies the portion of the farm that they want to buy, and then they price it, and it's a shotgun clause. So we get to either buy or sell at that price. And then assuming they buy, we go and sell the rest together. Assuming they don't buy, we actually go and sell the rest together, and then we sell the part we bought.
So just so we're clear, like a shotgun clause means that the vendor sets the price, and so no, the purchaser is going to set the price, and if they don't buy it, then somebody else gets to buy it at that price.
Correct.
Right.
Which is us. And so the reason we do that is, like I always say to our partners, you're picking the best. You're either going to pick the best stuff or the stuff closest to your house. Like if you can't buy the whole thing, the portion that you want is either going to be your highest quality land or the land that is the closest to you physically. Those are the only two reasonable things to choose. And you'll know the land really well. So you're probably going to overpay for it by like 5 or 10% because you know you want to get it.
Yeah.
And that totally works for me. Like that makes me really happy, really comfortable that that works. And we do a lot of things along the way that, and we'll also at the end, like we give them a lot of time to figure it out and work with their bank. We created bank history. Like there's a lot of other pieces. And then together we go and sell the rest so that we maximize the price of that.
Okay.
The partnership division, so this idea of kind of more than a third in full farm partnerships, around a third in crop share, and under a third in wholly owned land improvement, probably stays at more than a third in full farm partnerships, but the other two probably end up a little more equal.
Okay.
And then in terms of geography, we have 46% of our investment right now in Manitoba, 37 in Alberta, 17 in Ontario. Mm-hmm. Probably Ontario grows and Manitoba shrinks a little. But I could not be more pleased with like the diversification that we have, the partners that we have, the kinds of people we get to deal with on a day-to-day basis.
That's interesting.
Just to give you an idea of kind of where we are, the IRR before carried interest is 10.3%. So after carried interest is about 8.3%. Mm-hmm. The target has always been 8 to 12% net total returns. So we're within range. Mm-hmm. But what's really interesting is we never see this kind of performance this early in the fund.
Oh, that's right. Yeah, we were not expecting to see this so early. Yeah,
we are not expecting.
We were expecting to see zero or negatives.
Yeah, which is what you saw actually in those first 2 years. So if you see like the net income was actually negative in the first 2 years, has this slight positive, and then has some gain on land, and now a big gain on land and positive net income.
Yeah.
The positive net income, which is really significant, like it's $4 million across this portfolio right now for this year. It's not exactly real. Like a lot of it's from gains that happen when we trade between farms. And so I actually think you should think of this year as a break-even year, essentially on a cash basis. But that means that all of what I'm showing you in net income really moves to gain in land. So you still end up with it. It's just in a different place.
Yeah.
And that gain for this period is just, it's really strong. Mm-hmm. And the plus to that is everything that we did buy makes us look like geniuses. The minus is we are buying like that extra 25% of capital that I'm calling.
Yeah.
We are buying into appreciating market. Like the market is going up as we're buying. And so we need it to continue to appreciate. We need to operate it well. Like we need to do all the work that we said we were going to do to be able to produce the returns we want.
But given that this is a long-term fund, we've got the time and the patience to let land appreciate more.
Yeah. And to do like the really interesting part is this improvement work creates a lot of value. Like we aim for 40 to 90% uplift,
right,
depending on the project. And so the more of that we can do, the stronger we are.
Yeah.
If you want to break those down into like where the return comes from, about 50% is coming from land price appreciation. To put it in perspective, the other groups that buy farmland, buy land and then rent it to farmers, they have to rely almost 100% on land price appreciation bringing them returns. In ours, it's 50%. Land improvement work is going to be about 25% of your total return. So it has these really big gains, but we only do it on 20 to 30% of our land base. And then net income from crop production is likely to be another 25% of our total return.
Okay.
So if you think about a total return of 10%, 5 is coming from land price appreciation, 2.5 from improvement work, and 2.5 from net income over time. Okay. This is the just the pieces on income. So when I said it's break even, we end up with about $200,000 of operating income if we get rid of the gains between farms. Like we have one farmer that's retiring and selling land and younger farmers that are buying the land, and we're actually on both sides of that transaction because we remain invested.
Okay.
So all of those gains are reinvested. So it's a revaluation. It's not really a cash gain. And then we lock in our interest rates. We don't do it to play with hedging. Like we aren't playing an interest rate market.
Yeah.
We do it to actually reduce our risk. So but this year, because interest rates went up, we saw a $500,000 gain in the fair value of the interest rate swaps. Right. Last year, we actually saw a $2 million gain.
Wow. Rates did move a lot. So
they moved a lot.
Those are valuable contracts. Okay.
But as they move back, or as we hold these to maturity, those gains will disappear. And so we'll start seeing negatives there.
Okay.
So I want you to ignore the positive this year, and I want you to ignore the negative when we come. We locked in rates. Generally speaking, they're at 4.2 or below. We're really comfortable with them. They're 10 to 15 years. Like, they're really good from a management perspective. Yeah. But I don't think you can count their value change because we're not going to sell them. And then, like we were talking about, the positive operating income after fees and interest expense is actually better than expected at this stage in the fund. And the reason for that is, so two things. Our fiscal year ends at June 30th. So it runs July 1st to June 30th, meaning everything I'm telling you is actually about the harvest and sales from the 2022 crop. Okay. 2023 has also had a really good crop. Mm-hmm. And so it will also see very good profitability. But in 2022, all of that extra money that we spend is actually dead assets, meaning because our harvest happens at the beginning of our fiscal year rather than the end, we actually sit on a lot of assets because anything that we buy in October, November, December, January, February, March, it's actually not producing for that fiscal year. It's only going to come in the next one. So we're carrying a lot of expenses. And then we did have 11,300 acres that were too wet to seed in Manitoba. I don't know if you remember, but 22 had these like big floods in Manitoba.
Right.
Anyway, insurance covers it. It doesn't make you nearly as much money as if you grew a crop. Yeah. It was more than offset because of high commodity prices, but it wasn't a perfect year.
Again, why you diversify across Canada?
Exactly. That's exactly right.
Yeah.
To look at our partnerships, we can look Alberta, Manitoba, Ontario. And this gives you an idea of what kind of partnerships and how much the gain is from income and how much the gain is from land in a cumulative way. I think it's actually just really important for people to understand like how things are doing over the whole life of the asset. And the one I am most proud of is the top one. So because, and I'm not most proud of it because it did amazing this year, though it did amazing this year, and it does it again in like for the 23 crop. Yeah. I'm most proud of it because it was a big problem when we started. We had all kinds of issues there. We hadn't done as good diligence. We hadn't set the expectations up nearly as well as we do now. Like, it was our first investment, and we still were having some issues that we hadn't fixed yet.
Yeah. What year was this, Joelle?
2019.
Okay.
It was right at the beginning. Anyway, it has turned out great. It's a farm where we did a lot of land improvement. We hired an agronomist for additional advice.
Yeah. What type of farm is it?
It's so row crop. They're almost all row crop. Okay. They have some cows at some of them, but not this one. And so this is largely, it does some fescue and Timothy seed, but mostly canola, wheat, and oats. All right. Anyway, really, really tremendous results. Okay, weather. So there was spring flooding. This was again in the spring of 22. There were wildfires in the summer and this last year. But actually, those didn't affect the funds farms. And weirdly, because it was such a high dry year this year, the wildfires probably actually a little bit helped the farms because the smoke meant not as much sun came through and crops didn't quite dry out as much. All of that to say, even bad headlines don't necessarily cause bad impacts. But
Well, yeah, that kind of speaks to global warming in Canada, right? Like,
yeah,
bad news, but we're kind of benefiting right now from it.
Benefiting. Now, the piece that we don't benefit by, and it's true with this also, is like the volatility is real, and that's less good for everybody, including all crops. Commodity prices are super. I mean, there has been no more interesting time to follow commodity prices maybe than the last couple of years.
Okay.
So 21 has drought, and commodity prices start to rise. Yeah. The beginning of 22, Russia invades Ukraine and commodity prices rise. In 23, so the second half of 22 and 23, they are coming down, but they are still like almost, they're 30 to 50%, depending on the crop, elevated compared to their baseline beforehand.
Okay.
And so even like what you see here, which are the average prices over the 10-year period,
yeah,
in a line, and then the actuals kind of up and down.
These are nominal numbers. They're not real, right?
Those are nominal numbers, okay. Correct. But like
it looks like commodity prices from, not looks like it. Commodity prices from 13 to 21, they were flat.
They're flat, so, yeah. And they actually came down a bit. 12 had a really big drought. So what you see at the beginning of 13 is actually them dropping from a historic drought in 12. And they're flat, and then probably you will remember it because agriculture plays such a big role in Alberta. But we arrest the Huawei executive, and canola prices in particular drop. So that's happening here. So they stay super low. The neatest thing about this isn't the bits of volatility. It's that if you take this last 2 years of these higher prices, it has visibly moved up your average. So your average wheat price, if you go back and start just at 21, that drops a lot.
Okay.
Your average canola price would drop a lot. Like these averages are sitting way above your kind of where you'd think average was going to be between 13 and 21. While we and most farmers believe that commodity prices are likely coming down, so we didn't need them to stay where they were in 22. We don't need them to stay where they are. I actually don't think that, I do think that they're going to create a bit of a new floor, and it seems to be the general expectation. Like the prices you can lock in for next year are higher than your current average. So all of that to say, commodity prices are probably going to stay relatively strong, at least in a historical context. Interest rates are a really interesting one. And we touched on this really at the beginning, but interest rates have risen. The reason that the banks have all given, like the central banks have all given for raising the interest rate, the overnight rate, is that we are seeing inflation.
Right.
When they are looking at and measuring inflation, and particularly people's lives, a lot of what they are looking at is actually commodities. So in a lot of ways, it is a lagging indicator. Like the interest rate rises, which follow inflation, is a lagging indicator to commodity prices. And so your interest rates are in percentage are on the right-hand side.
Yeah.
But your farmland and your crop prices as a multiple are on the left-hand side. So your crop price, which, like you said, kind of runs pretty flat through from 2013 through 2020, is actually over or about 1.5 times what it was in that period. About.
Okay.
So the interest rate rise of a couple percent, and farms generally are holding like 20 to 30% debt.
Yeah.
Doesn't really matter because they're making so much money because the commodity prices are up.
Interesting.
Now, as a result, farmland.
Would these higher rates give you more opportunities for farm families that are in trouble?
Yes, and it actually gives us more opportunity with farm families that are not in trouble.
Okay.
Because the other thing that's happening at the same time as higher interest rates is much lower aggressiveness or liquidity at the bank level. So banks that used to be really aggressive about farmland are less aggressive. And part of that's because they have to test your income at a 7% or 8% reference rate now. And they don't just do that on this last year. They want to go back and use average income, so not historic context. But also, their goal is to make sure they don't lose money right now. It is not as much as it used to be to lend out a lot of money. And so we are seeing a much bigger pipeline, some of which is driven by that.
Interesting.
We have some really interesting social outcomes. We did not set out to save family farms. Wasn't our goal. We set out to make sure that the farmers we worked with earned equity and were in a better financial position and able to buy more land than if they hadn't worked with us, so under any other model. But we didn't expect that we had the capacity to save family farms because I didn't think we would have the expertise to work with people who were going bankrupt, frankly.
Right.
I thought, like, if you bankrupt yourself, you're going to bankrupt me, and that's bad. And I just don't have enough experience. But we had a first partner who came to us who was in a special loans and needed our partnership. And he was just really nice. He was like a really nice, really good guy, really good family. And everybody that we talked to agreed. He just got bad advice and then he listened to it.
Sounds like he's from Alberta.
Actually, Alberta's a little more independently minded, might not have listened. Might not ended up in his problem. He's from Manitoba, friendly Manitoba.
Nice.
And so so we worked with him, and I did it on the condition that I had one farm partner who would help mentor him. Anyway, that farmer had such a good experience that he said, if you do this again, I'll do this again. So he now oversees 5 of our partners. Wow. And those partners have created the majority of our returns. Like, they are overperforming. And we have great commitment. Like, everything about it works for everybody. 90% of our farms operate on a no-till or low-till practice. Means low tillage, so not releasing a lot of carbon because we're not turning the soil over.
That's good.
Yeah, well, I would like to say, like, we're doing all these amazing things. We're actually just in the norm for progressive farmers in the areas we work in.
Okay.
Which means the bigger story here is Canadian farmers actually are doing pretty good things. And the reason for that isn't because they're better people than other farmers in other countries. Yeah. It's that we have really low rainfall, particularly in the prairies. And the way that you conserve moisture in your soil is actually the same way you keep carbon in your soil, which is you don't till it, or you do it very well. Yeah. So really good outcomes there. We don't sell carbon credits because I don't believe that the metrics are real yet. And I don't want to greenwash anybody. But we do kind of watch that space and look at where we are and make sure that we're leaders within the category.
Right. So are these families from the names that you have listed on the top of the slide, are they going out to their network and saying, Area 1 Farms is a legitimate partner? Use them, or no, they're keeping it quiet?
Yeah. Nobody wants anybody to know that they have a partner. Why would you? No. It's not just your business, it's your life, and it's your community, and it's people that you go to church with, and it's people that you do rodeo with. Like, it's really a personal thing. And so we only have one partner that publicly says anything. Okay. All of the partners, actually, we have good enough relationships with that they will give references for us. So if a farmer who's thinking about it, wants to talk to them, they'll all do it. But almost nobody will disclose.
Yeah, that makes a lot of sense.
Yeah. Every employee is living wages. 42 families are building equity in their operations. So there's often multiple generations in the same farm. There's 24 farms as of June. I think we're now at 26. We have a very strong origination pipeline, 200 to 300 million. Kind of depends on the year. So to your point, higher interest rates make it more attractive. We've had a really successful social media campaign. We have a really strong reputation. So once you start looking into us, you really like our outcomes for all the reasons you saw. And there is this really interesting thing that we're just trying to figure out now, where there are some situations where large farms are selling, and those sales are a little tough because it's easy to find farmers, ironically, it's easy to find farmers that will be able to finance like a $10 million purchase.
Yeah.
It's actually hard to find farmers that will be able to finance a $50 million purchase.
Yeah.
And
the Hutterites will do it, or?
Yes, that's right. But not necessarily in all cases, and not necessarily the right places and stuff like that. I really the harvest we had was great. So fiscal year 2024 is likely to be quite good. As you would probably know, yields in Alberta were a little lower than average because of low precipitation.
Yeah.
They were much above what people expected them to be. Like when you looked at that crop compared to what actually came off, it looked way worse than what it yielded. But yields weren't strong, especially in specific areas. Manitoba actually did average or above average. So really good results. We expect positive income. We are lower levered than normal. So normally we put on 30%. We sort of stopped putting it on when rates went up, just because it was getting pretty close to our hurdle. And so we'll start leveraging again, and we'll kind of back into the right place, and then we will lock in continuous rates.
Thanks, Joelle. Let me ask some questions on behalf of my clients. Can you talk about how the fund is going to wind up, how capital gets returned to investors, and then if clients don't want the capital return and they want to continue to own farms, how does that work?
Okay, so it's actually a permanent capital vehicle. It's just a closed-ended one. So usually a permanent capital vehicle means you can put money in and take money out, and people are just buying almost like a public market.
Yeah.
We call the capital as we need it, and once it's spent, it's spent. So it's invested in those farms. At year 10, which in this fund is 2029, you decide if you want to stay or you want to leave. And we actually asked you that question 2 years earlier to give ourselves time to prepare for it.
Yeah.
And anybody who wants to leave, we either buy out at NAV, so at the appraised values, or if we can't do that, then we sell the farms. And if we can do that, we get to keep the farms and we keep the remaining investors.
Mm-hmm.
And
do you roll that into another fund number, or it stays as 4 in this case?
Stays 4. So it stays in exactly the same thing in exactly the same farms. And to buy out the investors who want to leave, either the current investors put in more money, or we refinance, or we sell some specific assets. And in any case, we bring that plan to the largest investors in the fund that want to stay, and we run the plan by them. And if they approve it, then that's what we do going forward.
Yeah.
That same election cycle comes up every 5 years after that.
Okay.
So 2029, 2034, 2039. So each of those time periods, again, with a 2-year lead time. And this fund is about 15% individuals and about 85% institutional. And we expect that the institutions probably want to stay 15 years plus if we're doing a good job.
Mm-hmm.
So if things are going well and we are performing to target, individuals will have lots of liquidity because of how we're structured.
Sure.
But institutions are likely to want to stay kind of that 15 plus year timeframe. And so we'll buy out at NAV.
Okay, so you're going to launch another fund, so you've got more opportunities for investors. Can you tell us about Fund 5?
Yeah, so we're launching Fund 5 this spring. We'll raise for about a year to a year and a half. And because Fund 4 is going so well, we really just want to do the same.
Okay.
It's a little bit right now of rinse and repeat. The partners are great. The structures are really good. Working together has been really good. Our outcomes have been really good. And so same idea in terms of full farm partnership, crop share, wholly owned land improvement opportunities.
Yeah.
Same idea in terms of geographic diversification, like 3 or more provinces. Same idea in terms of mostly crop production, mostly it's in land. So
what's your target? What's your target raise? Do you know?
Yeah, our target's 400 to 500 million, which is a bit of growth. The fund 4 was 313.
Yeah. Tell me about Saskatchewan. Why is Saskatchewan not in the mix?
Yeah, so Saskatchewan has a restricted ownership rule. That means you have to be 100% Canadian individual beneficiaries.
Yeah.
So as soon as we took institutional capital, we can't invest in Saskatchewan.
Okay.
It's actually the same rule in Manitoba, except in Manitoba, they allow for specific exemptions. And those specific exemptions depend on proof that you are benefiting the province of Manitoba. And because of the specific situations that we've been investing in, so a lot, like we talked about, like saving farms, those actually, we've gotten specific approvals in certain instances to invest there, which have allowed that.
Would you start a Saskatchewan-only fund and just keep it for private clients?
Yeah, it's one of our, so yes, is the general answer. The specific answer is everything takes time. It takes time and energy and focus. And we have really good options and outcomes from a pooled fund. And so it's a little hard to carve out the time and the energy and the focus to raise a separate fund. So we've thought about it a bunch. These funds, to get the diversification that I want, you kind of need 100 million plus. And so it's not clear to me how easy that is to raise from individuals. And to be fair, we don't deal much with individuals. Like there's only really 3 wealth managers who are interested enough in kind of creating this kind of diversification and bringing clients in. And we don't do any retail advertising. We make it super hard for people to connect with us. Like we only manage through wealth managers. So it has some hurdles.
Yeah. I mean, it's a fair amount of work to put this together. And so I get it.
It's not, the hurdle isn't the land. It's not the people. It's just the administration side.
That's right. Joelle, congratulations on the results for, this corporate year for you, and looking forward to seeing some more good things in years to come.
Thank you so much, and thanks for having me, and thanks everybody for your continued investment and support. And if there's anything I can do, let me know.
Absolutely. Wonderful. Okay, well, have a great afternoon.
Thanks, Marshall.
Okay, see you, Joelle.
Bye.